Hello and welcome to the Hawaii Housing Report. I'm Patrick ONeill, principal broker and owner at Luxury Homes International. And with me today, as always, principal at TZ Economics and Hawaii's most woke economist, Mr. Paul Brewbaker. How are you today, Paul?
Oh, I had to wake up. Sorry.
Okay. What? And by woke, I mean caffeine fueled, just
Oh,
for
I thought you meant
clarification there.
awakened.
Yeah. I'm sure you're that too. Too funny. Hey, so let's jump into it because there's a lot to talk about. In the latest inflation numbers came out last week,
Yeah.
and while it's still far above the desired levels, the deceleration possibly is some good news. What did you learn from the figures? How do you think the Fed's going to react, and how's that going to trickle down and affect us in the housing industry?
It gives the Fed a lot of room to complete its tightening of monetary policy, the rise in overnight interest rates for the last year and a half or so, year maybe, not even a year and a half. Um, a lot of room for the Fed to conclude this summer, maybe after just one more move to 5.25 overnight rate ceiling. I my own sense is they won't have to go to 5.5, but of course people are waiting, right? The jury's going to be out on US inflation for a while, but I think at this point we really need to distinguish Hawaii from the mainland. And unfortunately, monetary policy is conducted with respect to inflation on the mainland or nationwide, as opposed to what's happening here in Hawaii. But you can see this last green dot here at the end. Hawaii's inflation rate came in at 3.3% year over year. And you used the characterization. I can't remember how you described it, but you said a little farther away from where we were. But it's like for Hawaii, it's almost there. I mean, it's almost back to where we want it to be in the mid 20 teens. The Fed's target of 2% on a personal consumption expenditure deflator measure of inflation maps into about a 2.5% inflation if you measure it using the consumer price index, and in this case, it's the urban Hawaii consumer price index. And I've compared to the US urban average pre-COVID, pre-pandemic, those numbers were essentially the same. In fact, at or below the implied target of 2% on the PCE deflator and 2.5%.
Paul, let me ask
As I
you a
say,
question.
implied. Yeah.
So Fed target rate is 2%, as we know.
Yeah.
It was a number, and number is two.
Yep.
What about Hawaii? Would that be our ideal
You
rate
see
as
that? You see
well?
that horizontal line? I've got drawn a thick horizontal line. I'm not sure what color it is. It's kind of a
Yes.
purpley bluish thing
Mm-hmm.
or something. That's the 2.5% urban Hawaii consumer price inflation, consumer price index measure of inflation, the so-called headline rate. That 2.5% horizontal line is the inflation rate in Hawaii that would be consistent with the Fed's goal of 2%, 2.0%, measured by this alternate personal consumption expenditure deflator measure. So two is a number and the number is two if you're using the Fed's yardstick, but if you do it in meters instead of yards, because the CPI is a slightly different measure of inflation than the one the Fed targets, then the number would be 2.5. 2.5 is the number, and the number is 2.5 for Hawaii inflation. And you can see, as I say, pre-COVID, it was at or below 2.5. And then after the stimuli packages of 2020 and early 2021, the fiscal stimuli, the CARES Act, the ARPA legislation, and then of course the Fed's accommodation through low interest rates as well. That surge in inflation that came during the reopening was a mix of jammed up global supply chains and demand enhanced by the fiscal and monetary policy stimuli. And what we were looking for and what we're now seeing validated is this inverted U or even inverted V-shaped path where inflation goes up for a year and it comes down for a year. So inflation in Hawaii has been falling for a year. You know what I mean? People are still talking. I still get calls from reporters. Oh, what are we going to do about the inflation? And I'm like, you mean the inflation that's been falling for a year? So 1 year up, 1 year down, we're within a month or two of the Hawaii inflation rate being back to the Fed's target, which then means interest rates could fall. So let me push through a little bit. Just let's break down the Hawaii inflation into two pieces, one of which is what I've called the headline rate, the one that is literally the one they're talking about in the headlines, and the one that's called the core rate, which is for people who don't eat or drive. The core rate is inflation without food and energy costs.
More
And this,
volatile, the more
it's a
volatile
two more
components.
volatile components. So for example,
Mhm.
after the Russian invasion of Ukraine, grain prices shot up because the Ukrainian grain harvest was suspected to be impaired. And energy prices shot up because Russia's exports of oil and natural gas were subject to sanction, et cetera, et cetera. So those kinds of volatile elements, if you remove it, you get the core rate. Both core and headline inflation in Hawaii have come down. Core inflation to 3.0%. The headline rate we just looked at, 3.3%. So again, progress on both fronts. The gap between headline and core, you can think of that as the part of inflation that was coming from the disruption to the global supply chains, or say the Russian invasion of Ukraine. But the core rate is the one that the Fed's looking at. The Fed's looking to get the core rate, kind of the inflation rate when you strip away the volatile pieces, to get that core rate down to their 2% goal, which for Hawaii, in terms of the CPI, would be 2.5%. So we're very close. We'll be there by this summer, which means we can begin to expect interest rates to fall. And just to be clear, inflation in Hawaii is almost 2 percentage points. I mean, it's headed towards the lower bound of a plus or minus 2% range for the last 80 years relative to US inflation. So Hawaii's below average. That's kind of good news from a consumer standpoint, that is, inflation is not as bad as it was nationwide. And again, this inverted U or inverted V-shaped trajectory means it's almost at an end. But unfortunately, it's also a sign that Hawaii's maybe not got the same oomph that the rest of the mainland economy has. That's a subject for a different day. Meanwhile, the Fed last month reiterated essentially its prior forecast for the overnight rate to peak this summer at maybe 5.25 and to come down over the course of maybe 2024 and 2025, maybe 2026, you see, come down to their expectation of a long-term rate, which is also 2.5%. That's for overnight money. And therefore, the longer-term rates, for example, the yield on the US, on the 10-year US Treasury note, that's a popular benchmark for mortgage rate pricing, those rates, the longer-term rates, are already front-running. They're coming down ahead of the Fed's anticipated validation of the ability to remove the tight monetary policy they put in place as a confirmation that inflation has abated. And if that's the case, then this extraordinary 4 percentage point increase in mortgage rates, which we haven't seen for 40 years, a one-time move of 4 percentage points, that one-time move has done its job, has slowed down investment, particularly housing investment. And since November now, for about 6 months now, you've seen those mortgage rates slowly ebb back towards 6% from 7% in November. And I would imagine through the remainder of this year into the fives and maybe even into the high fours when we get to this point a year from now. Now that's a conjecture, but again, one that's consistent with the interest rate forecast we're looking at.
That's certainly good news. And so, Paul, coming up, the May meeting of the Fed.
Yeah.
You think there's still that we're talking right now 25 basis points? Does that seem to be the?
So there's two ways they could approach this. There's more than two ways, but sort of the two leading ways would be to raise the target rate by 25 basis points and provide forward guidance, right? Signal to the markets that unless something scary happens with inflation, they're probably done. They're
I see.
probably at the end of that tightening process. Or
Yeah.
they could say, in light of recent disinflation, in light of the recent subsidence of inflation, and given our concerns about financial stability in the banking system, because you have to remember, we've had a couple of bank collapses that have raised questions about systemic risk and have resulted in a credit tightening. So even without raising rates, credits become tighter to get a hold of. So they might make an announcement that says, we're not going to raise rates this time. We think that credit conditions have tightened enough to do the same job. We're encouraged by the disinflation we've seen in the most recent statistics. We leave
Yeah.
the door open to raising
Right.
rates in the
I
future
see.
should circumstances warrant it.
Right. Yeah, and you mentioned the credit crunch for commercial refis right now.
Yeah.
It's really bad. And I think there's
Well,
some big pain coming up unless something changes. The regionals are all pulling back on that lending, but we're gonna stick to residential. So on that,
yeah.
let me pull, actually let's pull in Anders Hostelley.
Yeah.
Anders, oh, there he is. All right. Anders is
Oh,
Senior Vice President at Guaranteed Rate, which is one of the largest mortgage companies here in town. And Anders, let me pull up the Freddie Mac
sure.
interest rate chart and then get your comment on this. I think you mentioned this earlier. It seems that things have just sort of been bouncing around in the low sixes.
Yep.
This is the published rate at for the 30-year fixed at Freddie
Yeah.
Mac, 6.27.
Mhm.
How does that compare to the mortgages you're actually transacting? What sort of rates are you seeing today?
Yeah, we're seeing in the low sixes. Of course, somebody with good credit, a nice size down, 20% down or more. So this is, these rates are right in line with that. I mean, you can
Oh,
still get under 6% in the high fives, but you have to pay points.
I see.
And we do see more borrowers doing that now, just so they can get a little bit of a lower rate, and it could, obviously helps them with qualifications as well.
So on a 30-year fixed, let's just say someone is paying point or 2 points. How does that affect the rate? Where does it end up then?
Yeah, then we're looking, again, it depends on their credit score and exactly how much down payment they put. But you could see, in the high fives with paying
Oh,
a little bit more. Yep.
and then are the ARMs becoming more popular, the adjustable rate mortgages, or not so much?
A little bit, but I think they were a little bit more popular. They had a little bit more attractiveness maybe a couple months ago when rates were higher, or rates, when we started topping 7%, definitely that was the case. But it seems like more people are going back or just, asking about 30-year fixed rates.
Gotcha. And with a typical adjustable rate mortgage, if someone doesn't know, generally there's a period where that's fixed, right? A 3 year
Correct.
or a 5 year.
Yeah. So 5, 7, or 10, if you hear that, then it means it's fixed for the 5 years, it's fixed for the first 7, fixed for the first 10, and then it adjusts every 6 months thereafter is a
And
typical.
okay, and then those rates, like what's the difference compared to the 6.27 that we see with
Right now, maybe about, if you're doing a 5 year, there's a bigger spread between the 30-year fixed. But you're not looking too much. I mean, it's maybe 0.75% an interest rate better on an ARM
oh, I
compared to a
see.
30-year fixed. Yeah.
Yeah.
And
And
and just going back to what I was saying earlier, when 30-year fixed rates were going over 7%, then the spread was larger between an adjustable rate and a 30-year fixed. But now, because the 30-year fixed rates have come down a bit, the spread really isn't as large. The
I
gap is
see.
big.
I got you. And Anders, you've told me before, you track rate lock in new prequals that are coming in. What does
Mhm.
the activity look? Is it still similar to what it was last month? Are you seeing
Yeah,
any
it's
uptick?
pretty similar, maybe a little bit more than it was last month. We're right now, well, we're in April. I mean, you kind of hear about the April or spring, I should say, spring buying season. So there's a little bit more activity where people are looking to buy and then kind of move over the summer. So their kids, go to a new school. They start up in September. So that's, there's always a little bit of a pickup at this period of time.
Okay. And you're probably well aware of the seized up markets, credit markets for the commercial side, are you seeing any tightening on qualifications or any changes on the residential side?
Yeah, not really. No.
Okay.
So for 30-year fixed, Fannie Mae, Freddie Mac, I mean, guidelines are pretty, we really haven't seen anything kind of tighten up, I'd say.
Okay.
Then it's interesting. We're seeing all these other kind of exotic loan products, these non-QM loans that are out there, where somebody can qualify just based off of their bank statements or the rental income on a property if it's a rental property.
That's good to hear. I like hearing that.
Yep. Yep.
Yeah, the exotics. And
Yep.
okay, we put you on the spot here. When do you think rates will fall below 6%?
I mean, of course, I'm just here out in Hawaii, just kind of looking at it and just kind of based off of my experience. Well, we could see that in the next couple months. I actually think in May, maybe we'll see the rates come down a little bit more from where they're at right now. Yeah.
Oh, good to hear.
Yeah.
And when do you think rates will fall below 5%?
Man, I don't know. I'm not even sure if they'll do that this year, to tell you the truth. Yeah.
Yes. But you think it's possible heading into the years ahead?
Correct. Yeah, absolutely.
Yeah.
Absolutely.
Okay. Awesome. All right. Well,
Thank you.
Thank you very much for sharing the real world data with us, so we know what's happening on the streets, and keep us posted, and we'll stay in touch.
Appreciate it. Thanks for the opportunity.
Thanks, Anders. All right. And we're going to take a quick break, and we'll be right back with Hawaii's favorite economist, Mr. Paul Brewbaker. So stand by. Don't go anywhere. Hello and welcome back to the Hawaii Housing Report. I'm Patrick ONeill, and with me, the economist, Paul Brewbaker. So, Paul, I hope you enjoyed having Anders in there. It's nice to have some information, real information, right?
Yeah,
rather than just
right.
our statistics.
Right. From down on the street. Yeah.
That's right. That's right.
And
did you have something you want? Yeah.
Well, to be of a like mind, basically, to be validated.
That's right. You're validated. You want me to emotionally validate you, or? So we were talking about interest rates. We were talking about the credit crunch we're seeing for the commercial market. Did you have something you want to add to that?
Well, I just wanted to point out even without what's going on with monetary policy and interest rates and mortgage rates in particular, I think commercial real estate was going to have trouble anyway. Just a reminder that one of the legacies of the pandemic is that in the surveys now, about 20 to 25% of people in Hawaii report having teleworked or having worked from home in the last week. Now, that's not necessarily full time, but that number was less than half of that pre-pandemic. And moreover, if you look at this trend here, it's drifting a little bit upward. I don't think it's going to go up anymore. I think it's basically sideways. But we have even more detailed monthly data now to show the breakdown between maybe 11 or 12% of workers who are working from home full time, and another 10 or 11% of workers that are working from home at least part time, several days a week, if you will. And then 70% of workers that are working full time in the office or in the conventional workplace. A small share of people have not responded in these surveys. So it's maybe 75-25 or something like that. 70, it's probably not 70-30. It's probably not 80-20. You see what I mean? And what's more important, these are monthly data going back to last summer. It's really stable. This is not changing. And so when you look at how much time people spend in workplaces relative to the amount of time they spend at home, there's been a huge drop in the amount of utilization of commercial space and office places in particular.
Office has been devastated. Office is devastated, and a lot of those loans are now going to come up. They're going to be due, and the credit markets have really tightened.
Leases are not going to be renewed, right? We haven't seen all of the fallout. Now, notice that time spent at home has not gone up by as much. That is, people are using the time they're not spending at work to engage in other activities, but among them are not, and I took this slide out, but if you look at retail and recreational establishments like gyms, food service establishments, the pattern in the past has been that people stop on the way home from work. They stop at the mall, they stop at the gym, and they stop to pick up dinner. And as that drop in time spent in the workplace has first manifested during the pandemic, then rebounded a little bit and stabilized at minus 30%, let's say, the utilization of retail space and food service establishments and recreational establishments like gyms has fallen 20%. So it's in the office space, it's in strip malls, there's been an e-commerce outcome. E-commerce has been boosted, traditional retailing, not so much. Brick and mortar is under pressure. And all of that's being thrashed out in the commercial real estate environment. Most recently, of course, bank failures and a generalized credit crunch has focused attention on this particular vulnerability in the real estate market, in this part of the commercial real estate market, not industrial space,
Right.
not resort,
well,
not
multi
hotels.
Yeah.
Multifamily, not a problem.
Right. Okay, well, let's jump in. We'll head back into our residential world, and we're going to take a look at the statistics recently released by the Honolulu Board of Realtors. Let me pull those up. And by the way, if anybody would ever like these full reports, we do have this on our website. You can find our address down below in the description. So we're looking at the closed sales. This is year over year. Not a real big surprise, but I wanted to focus on our year to date. So we have 3 months of data. Single family homes are down 37% compared to year to date last year, and condos about 39%. Paul, you see in the lower right hand, I put in some years that were substantial drop-offs. 1991 after the Japanese bubble, 2008 after the financial crisis. 2023, we were down 23%. Right now, year to date, we're trending in the high 30s. Do you think we're going to set another record this year?
So that's in the lower right. That's minus 30%, minus 24%, and minus 23%, right? Not plus.
That's correct. Yes.
So those are big declines. Those are annual 12-month totals. We're looking here at a 3-month total. But guess what? Those 3 months, the first 3 months of 2023, are probably the worst, the absolute worst moment for the current, for the current cycle, the current collapse in sales. Patrick, can I share one more picture?
Yes, absolutely.
Let me just to illustrate what you're talking about. I'll go where I left off, because the next slide, in this case, literally is the sales history here on Oahu. And you see that right here at the tail end, that V-shaped decline in single family home sales volumes and in condominium sales volumes. That's first quarter of this year. That's literally what you were showing is the bottom of this V. Now it's already rebounded in February and March from the January low. And the January low is associated with the November high for mortgage interest rates. But to your other observation about historical context, you can see the same kind of V-shaped event after the onset of the pandemic, after the collapse of Lehman Brothers in 2008, a little small kind after 9/11, but a big one associated with Operation Desert Shield in the Persian Gulf War era. And then this, I think, an important one, the Fed tightening of 1994, which produced two interesting outcomes. One was a soft landing for the economy, so no recession. And the second was this epic 10-year long climb in sales volumes. Now, I don't think we're going to see this in the magnitudes we're looking at here. And in particular, we're not going to see another bubble. But I think the lenders are all smarter than that now, and the regulatory environment is much stricter than it was at that time in the late 1990s, early 2000s. But it's very conceivable that we would see from this starting point 250 sales per month, moving maybe to 300 sales in the single family space, monthly sales on a seasonally adjusted basis, and then moving from 350 to 400 very quickly over the course of the next 6 to 12 months. We could see sales volumes as we move out of 2023 into the mid 2020s, restoring the pattern we saw in the 20 teens. That is, we're going to go back to normal relatively quickly. And the thing to watch, as Anders suggested and I conjectured as well, is when those mortgage rates punch through the 6% threshold into the fives, and then maybe next year, if they actually pierce that 5% layer and go even
Yep.
lower.
Yep. Understood. Okay. Well, let's go back. Now let's take a look at inventory, what's happening there. So we've looked at the closed sales here, and there we go. Okay. Active inventory. If you were looking for a home last year at this time, inventory is now up 50%. That's good news for a buyer. Condos are up 25%. And what's curious is that's without, or we're adding less homes than we were adding last year. You can see we've added almost 30% and 26% less properties. When we look at this,
Yeah.
obviously we're getting this pile up, right? It's 3 times longer to sell a home. Right now at 36 days, it was 9 days this time last year, and for condos up to 24 from 9. And then you and I talk about this quite often. Months of remaining inventory, which really is the supply against the absorption rate. Although it's double what it was last year, 2.1 and 2.4 generally indicates a seller's market. Would you agree?
Yeah, I mean, I hate to say it, it's kind of like a pileup on the freeway where sales stopped, so the cars are piling up, and nobody's getting on the freeway, like nobody's listing.
Right,
So,
right.
yeah, the image, months of inventory have doubled. Days on the market have lengthened out quite substantially. Takes longer to sell if you're even going to list. But again, based on what we've been talking about so far in this discussion, I expect those numbers to really begin to turn around fairly quickly in the second half of this year. And the key is going to be this summer season. Anders alluded to this. Sales begin to pick up in April and May as people are planning moves to occur before the school year starts in the fall. So it's going to be very telling how these things unfold over the summer months this year.
Yeah. And we've been scratching our heads trying to figure out why no inventory is being added. And as I've talked to more homeowners, I think part of it is most of the people who own a property right now are locked into an interest rate in the threes, maybe even less. And if they go move and buy something else, they're coming out and the rates have doubled. So it's going to affect that as well, potentially.
Well, and it's going to affect the price that they receive when they sell their house. Last year, they would have gotten 20% more. So it's worth waiting. It's wait till the dust clears a little bit, and and the constellation of influences moves back into a more favorable alignment for both buyers and sellers.
Okay. Well, let's talk next about pricing. And I want to take a look back at a little historical context and where we've been and where this thing is going. We're going to take a quick break. We'll be right back with economist Paul Brewbaker. Okay, and we're back with economist Paul Brewbaker. And by the way, if you're enjoying this information, please do give us a thumbs up down below. And if you'd like to be sure you get next month's report, hit the subscribe button. Okay, Paul, so we're going to jump into pricing. And let me pull the information up again. This is from the Honolulu Board of Realtors. And here we go, median price. If we look at median price compared to last year, year over year, I guess you could call it relatively flat, down 6% for homes, actually up 4% for condos. But in a historical context, this is where it started to get interesting. If we look at the same time last year, home prices were up 21%. And if we go back to 2021, 17%. And if we go back to 20, 3.5, and then 19, 3%. So I'm going to shoot to another chart. Again, this is from the Honolulu Board of Realtors. This is 38 years of data. And I'm going to focus down at the bottom. We have the median price growth. And for a home over the last 38 years, it's been 5.24%. For a condo, 4.68%. I know you have data that goes even further back, but this is available from the Honolulu Board of Realtors.
Yeah.
So I wanted to look 2010, I think we'd all agree that's when the real estate market kind of corrected coming out of the financial crisis. And we
Correct.
had this
That's right.
nice, yeah, we had this nice long run to 2018. 2019, the property market in Honolulu is actually correcting. But if I draw
Hmm.
a line through this, the appreciation during this period was 3.61%.
Single
And if I
family, yeah. Hmm.
single family homes, if I take and bring it all the way to 2022, where we hit last year, the records, that brings us to 4.9%.
You'll have to
Both
shave
of,
off that point 0.9 once you put 2023 in there, I fear. But yeah,
yeah, probably, right? But the compared to the long term, the last 38 years, we were at 5.24.
yeah.
We're trending below the long-term trending line,
The difference
right?
is about 1 percentage point, right? The difference, you're basically looking at red is 4, green is 4 after you take out the point 0.9, and the 38-year number is 5.25. But if you go back to the 1980s, the inflation rate was about a percentage point or more higher. So most of the difference is higher inflation in the 80s, fading in the 90s, and the more recent low inflation environment we looked at the beginning of this hour, more like 2%, or 2.5%. The Fed goal is 2.5, but we actually probably hit 2% on the urban Hawaii CPI in the 20 teens. And
Mhm,
that's important because if the number is 4 in nominal terms, the escalator you just showed, where it
mhm.
basically averaged out, to 4%. If you subtract the 2 percentage points of inflation that we contemporaneously experience every year, then that's 4 minus 2 is 2% in real terms, which is right on the number for
Mm,
long-term real appreciation.
I see. So in a way, it really is when you adjust for the inflation through
Well,
these
just for
periods.
inflation, we also have to adjust for seasonality, but thankfully, I actually have those numbers. And right off the top, mahalo to the Honolulu Board of Realtors for publishing all this data and for having done so since the mid 1980s. And mahalo for to you, Patrick, for sending me the report every month. What I do is I take those monthly statistics and I remove the seasonality to which Anders alluded earlier. He talked about sales picking up in April and May and building and maybe crescendo peaking in the summer. In the same way, prices tend to have a seasonal component at monthly frequencies. And so if I take out the seasonality, you have these nice illustrations of seasonally adjusted prices where the single family prices in the 20 teens on Oahu moved, the median prices moved on this escalator, climbing at 4% per annum. And there's that little fade you talked about in 2019. And then the post pandemic surge, a kind of a COVID mini bubble that has now unwinded or has unwound. You were referring to the first quarter data being down year over year after a couple years there in 2021 and 2022 of sharp increases, 20% increases. So some of that's unwound, but what's most interesting, if I go to this January, February, March of 2023, the first quarter transition in this data set, is it looks like it's going to settle back onto that path. Now, on the condo side of the market, you also did the arithmetic and found that there were slightly higher rates of appreciation. That turns out from a lower trough in the early 2010s. Again, a little bit of a fade here in 2019, but less of a response to changes in the pattern of housing demand that followed the pandemic. And if you think about work from home, as we looked at just a second ago, and part of the reason I brought it up, a shift towards more people working from home at least some days a week, if not maybe a doubling of the number of households in which you'd find people working from home full time. That also changed the pattern of demand, shifting towards detached single family dwellings and also spatially shifting towards homes that are farther away from a downtown or a Waikiki or, you know, agglomerations of economic activity because people don't have to commute the way they did. Turns out we can also show in the data that people don't leave home as early as they used to post pandemic. They leave about an hour later now because just enough people have chosen or have the opportunity to work from home that there's a little bit less congestion. At any rate, the point here, these prices do seem to be converging to the long run trend. And to back you up on both the bubbles and the longer term trend, we have these Federal Housing Finance Agency data where the data are consolidated, all homes, single family and condo, and where I have removed the inflation in addition to removing the seasonality. And guess what you get? A 2% long, 2 to 2.5% long-term escalator, if you will, punctuated by bubbles that come and go. And then this mini bubble we experienced, which I'm going to guess is going to look very much like the predecessors with less amplitude and a more rapid return to the underlying path. So signal after signal after signal we're getting of a disturbance, right, in the matrix over the last couple of years with inflation and Fed policy intervention, but a return to a likely return in relatively short order. I'm talking about the next 6 to 18 months at this point, to a path not unlike the one we experienced in the 20 teens, where we just get on the escalator and everybody gets back to work. Obviously, some house cleaning, some layoffs, and companies reorganizing and consolidating to make an adjustment for the current upheaval in the housing market, but
Yes.
pretty much getting back to normal
Yeah.
in pretty short order.
Oh, well, that's good to know. Okay. So, Paul, we go to my favorite part of doing this together. We're going to go to the lightning round. Going to switch it
All
up a
right.
little bit today. We're going to
Yeah.
look for some predictions here. Okay. The first one is going to be, what's the Hawaii inflation rate December of this year? Where are we going to be?
So it'll be a November statistic. It's every other month, odd numbered months now. And I'm going to guess 2.6.
Wow. Okay. What
From
about
3.3, it's not a big
right
decrease, but
now?
yeah.
But that's okay. How about the 30-year fixed rate mortgage interest rate in December 2023?
December of 2023, I'm going to say, wait, I have to channel the psychic hotline, 555.
Okay. All right. When will the Fed begin cutting rates?
Oh, not till the summer of 2024.
2024. Okay. And then the final
Second
one, you
half, yeah.
may have said this earlier, but when will the 30-year fixed rate mortgage fall below 5%?
Oh, 2024.
All right.
So,
Let me
small
check.
kind. Small kind.
Small kind. Okay. All right.
4.99 counts.
Okay. All right. I'll check with the judges. Yes, they say
Yeah.
you're correct once again. Thank you.
As
Well
always.
done. As always. Oh boy. Paul, always a pleasure spending the time with you. Again, for those of you who are watching, please give Paul a thumbs up down below. Add to his social media clout. Very important to him.
Yeah. Oh, yeah.
Yeah.
Follow me on
Boy.
TikTok. Yeah.
That's right.
No, I don't have a TikTok account.
I knew that. And want to thank Anders Hostelley from Guaranteed Rate. Really great to have him as an addition to hear what's happening in that world. So, Paul, always a pleasure. Can't wait till I see you next week. Have a great time and aloha.
Aloha.